We will now focus our attention on equities. We will look at the different form of equities from ordinary shares to preference shares, as well as understanding elements of corporate actions that will be relevant to you, especially when you are engaging with investors and trying to build an investment portfolio for them. Okay, now we're going to look into ordinary shares or equities or common shares, whichever way you choose to go about it. As we know, if a company is in a position to list its company on the main market, they will distribute shares in order for investors to purchase them and benefit from the growth. Now, a company will do that in order for it to raise long-term capital. There are multiple ways that it can do so. That can be either via the equity route by offering shares or by issuing bonds, which is seen as debt, as we've already discussed. Now, this tends to be a fundamental part of many investors' portfolios, so it will be a lot of the people you will be speaking to will have predominantly equity portfolios where they are holding it for the medium to long term. So that is the base of their portfolio. The elements or the benefits of doing so, or purchasing shares, is first and foremost the growth part. You benefit in if the share price does go up in value, if it continues to produce great results, got great momentum. The markets and the whole economy is very much in an upward motion, and share prices are up. That's when stocks obviously do very well for shareholders. Second element is dividends, which is a form of income. This is when the company does distribute a fraction of its profits to its shareholders as a form of reward for their loyalty. Thirdly, you will get voting rights. You can be in a position where you can vote at AGMs, and you can really have a vote on very important corporate matters. It could be appointment of board directors, it could be approval of M&A, any form of mergers and acquisitions, any other form of corporate actions that a company may wish to bring to the table. There are a number of rights offerings that we will discuss, predominantly rights issues and bonus issues. But yeah, the key for yourself is when you are speaking to your investors, just be fully aware that they are going to be heavily invested within equities. You just want to build a larger picture of what percentage of their portfolio is dedicated towards equities. Have they ever thought about diversifying even within an equity portfolio? What sort of direction are they taking? Understand their overall objective. Be very clear. So, ma'am, what is your objective? What are you looking to achieve in the current market or with your portfolio? If they are looking for naturally growth, you want to ascertain the stocks that are within that portfolio. What equities does he hold that will benefit from a rally, for example, or overall growth in the market? You may want to be looking at high beta stocks, especially if he's focusing very much on low beta. So, and that goes vice versa. If he believes that the market's going to have a pullback, we are going to experience a collapse, you have to understand where his equity portfolio is. Is he massively involved in high beta stocks? As we know, history does show that periods of uncertainty and downturns, we will get high beta companies and sectors fall harder than the overall market. So you just really want to understand where their portfolio is and if they're really matching their current investment objective. Okay, now I've just got a very quick example of how dividends look and how they are distributed towards investors. So suppose you do own 100 shares of a company, that could be Barclays, for example, and the company announces a dividend of 50p per share. So what you would then tend to do is times the dividends per share by the number of shares that you currently own, and then in turn you will get a figure of £50. That means whether it's annual or semi-annual, you will receive a dividend from Barclays of £50. Okay, so this is just a very quick example of dividends. Okay, companies issue dividends for a number of reasons, and I've listed most of them here. So when we talk about rewarding shareholders, dividends do provide a direct return on investment to shareholders. the company does distribute a portion of its profits as a way of rewarding shareholders for their investment as well as their loyalty. This does tend to attract investors. So regular dividends can make a company's stock a lot more attractive to investors, especially those that are seeking income. And it's not just for slightly elderly or individuals coming onto retirement, but it can spread to any sort of age bracket. I believe all portfolios should have elements of income associated with that. Reason being, it does provide predictable returns on a yearly basis. It's a great way of demonstrating financial health. So issuing dividends will signal to the overall market that the company is not only financially stable, but also generating significant or sufficient cash flow. So it does suggest that the company is confident in its future earnings and has a sustainable business model. The competitive advantage side is important. As a company that pays dividends regularly and on a significant amount can differentiate themselves from their competitors who do not. And that's important in multiple different industries, as if you are representing a client and you are looking to add an income stock to their portfolio and you're looking at a utility sector, would you go for National Grid or would you go for United Utilities? And that will naturally depend on which company is consistently providing dividends, and more importantly, which one is at times providing the highest dividend. But the most consistent dividend is one of the more important things. So you can get that predictable income on a yearly, annual basis. So again, another great way of demonstrating the ability to bring in further investors and attract further investors. Now, when we talk about the balance sheet, it's just leading on from our financial health aspect, especially if you're focusing very much on fundamental analysis. It does signal to investors that it has a solid financial foundation with adequate reserves and manageable debt levels. Okay, so dividends overall does provide a tool for companies to share their success with investors, and it does enhance their overall market appeal. So yeah, those are the key reasons why companies issue dividends, and naturally why it will attract many investors. Okay, we're going to be looking into a rights issue right now. It is a corporate action. It's very common with a lot of companies, so always be fully aware if rights issues or bonus issues are taking place, as it will have an impact on the overall share price of a company. But yeah, let's break it down bit by bit. When I talk about a rights issue, in essence, it's an invitation to existing shareholders to buy new shares in the company at a slight discount to the current market price. And the reason why companies do a rights issue, we will come into the reasons, but the main thing is to raise finance. It's one of the easiest and cheapest ways to raise finance, and they could use that new capital for multiple of different reasons, which we will come on to. Now, the example that I've got here is it normally comes as a ratio. Remember, I've done 1 to 5. It can vary. So what this means is for every 5 shares that you own in the company, you are entitled to an additional share at a discount to the current market price. So if a share is currently at £2, a rights issue may come out and you can purchase the share at £1.80, for example. Now, it's great, you get additional exposure within the company, but there will be a dilution effect, which we will touch on to. Now, when we talk about the subscription period, it is usually for 21 days, and it is predominantly designed for existing shareholders. Okay, it's not something that's marketed outside of existing shareholders, so it naturally will come to or be offered to existing shareholders straight away. Now, the shareholder has a number of options. They can take up the rights and purchase the shares at a discounted value, so they can take up the rights in full. They can sell their rights if they don't feel they want any further involvement. Their proceeds can, or their rights can be sold on to other shareholders. They can sell partial amount of their rights issue in order to raise finance to buy the other remaining rights issues. So that's one way of going about it. They can do nothing, allow the rights to lapse. So what tends to happen is the company will tend to sell the rights on and deduct any sort of fees or any costs involved, and any proceeds will be returned back to the shareholder. But rights issues are very common, and we've had quite a few of them this year alone. The reason why you have to know about them is when you are speaking to your investors, you want to make them aware of any future or current corporate actions that are taking place. It does demonstrate your knowledge and your understanding of the current market condition, and that's something they will really appreciate. Okay, there are a number of effects attached with going about a rights issue. As mentioned, um, by going through a rights issue, the company is looking to raise finance, and we'll come on to the reason why they do it. Um, but by doing so, they are offering additional shares in the market at a reduced price. This, in essence, will dilute the overall share price. Okay, purely based on the fact that the total number of shares outstanding has increased, while taking into fact that whilst those shares have increased, the value has also been reduced for what they're asking for the shares. Okay, so especially for existing shareholders who did not participate in the rights offering, they will be affected more, you could say. But even if existing shareholders did take up their rights and they did purchase the additional shares, their ownership percentage will still decrease. There's nothing they can do about it. But let's use it in an example. So, for example, let's say a company has 1,000 shares outstanding, total number of shares that investors can buy, and you own 100 of those shares. That will give you a 10% ownership stake. Now, if the company issues an additional 100 shares through a rights offering, and you did not participate in that, the total number of shares outstanding for the company now will be 1,100. Okay, so just the added 100. Since you didn't take up the rights issue, you still own 100 shares, but your ownership stake has gone down from 10% to 9%. Okay, that's the effect of a dilution to investors. And even if you did take part in the rights issue, you still wouldn't have a 10% stake. It will reduce your overall stake. So in summary, dilution occurs because the company's ownership is now spread across a larger number of shares. So while dilution reduces the ownership percentage of existing shareholders, um, it can also affect the fundamentals, especially when it comes to investor ratios such as earnings per share, which have part of their equation is the number of shares outstanding. So that's one thing very much to take into account. Now, why do companies do rights issue? The primary reason is to raise additional capital. They may need this capital to raise funds. It could be for financing expansion. It could be down to a strategic acquisition in order to grow the business, reduction of debt, or just to strengthen the overall balance sheet. Now, when we talk about reduction of debt, it's important to understand what that can do for a company. The company may have to go through a debt restructuring program where they may use the proceeds from a rights issue to wipe off any debt it has, or even just to reduce it. It will then reduce its interest expenses and improve its overall financial stability, especially when it comes to the solvency aspect. And a lot of the solvency ratios will be affected. So, you could see that as a positive sign. The company's used money to repay its debt, and then it could be on a level playing field where it can compete with the other companies and in turn grow in value. It could also be just purely down for shareholder support. You know, it can be a way for a company to demonstrate its commitment to existing shareholders, but by providing them with the opportunity to participate in this form of fundraising. Okay, because you may they may take a long-term view. You may think in the initial term, my overall portfolio value within this stock has gone down, but in the long run, if the share price increases and keeps rallying, now you've got further shares in the company, and more importantly, you bought those additional shares at a slight reduction to current market value. So your yield at the end may be far greater. Okay, now we're going to take a look at a bonus issue. It's a method of issuing shares to existing shareholders. It does go by other names such as a capitalization issue. It can be a scrip issue. It has many similarities to a rights issue, by the way that um, new shares are issued to existing shareholders. But the big difference is a bonus issue is issued free of charge. Okay, there's no way of raising finance with a bonus issue. It's just literally giving existing shareholders further shares within the company. Okay, that's one of the big difference between the two. And the obvious question you will ask is naturally going to be dilution. So the effect of a bonus issue is to dilute the existing market price of the share. You know, it could be for many reasons, but usually when a share price has reached a level which is causing a lack of liquidity in the marketplace, or is relatively high and not as popular, you know, it can be very difficult for new investors, or existing investors may believe that, you know what, this share price has reached the ceiling. It's not going much higher. And investors from the outside will be looking in thinking, wow, this share is, you know, too expensive, especially compared to its competitors. So that's one of the key reasons why why companies will issue a bonus issue. It tends to be a marketing ploy at times. Okay, the board will decide, you know, the ratio. It will indicate the number of bonus shares to be issued per shareholder. So, for example, the ratio could be 1 to 1. Okay, you're highly unlikely going to see a ratio like a rights issue where it'll be 1 to 5, or it could vary. In fact, there's no predetermined ratio. It can be any ratio that they see fit. Okay, but there are a number of effects. Bonus issues will increase the number of shares in the market, and especially with no finance being raised, it will have a big impact on earnings per share. And especially when we come on to looking at fundamental data, I will explain how this is relevant to how companies can potentially manipulate their earnings per share figure to make them look a lot more profitable and a lot more valuable. So whenever you see a bonus issue in the market, you know, always make your clients fully aware and understand the reasons why a company may do it. It's not seen as a negative. Okay. Sometimes by doing a rights issue and you devalue the overall market price, it can capture a new audience, and not only retail investors but institutional investors. They may see it as a great opportunity to enter a good, wholesome stock. Okay, we'll look at a number of reasons why a company will go through a bonus issue. One of the reasons would be to reward shareholders. And now you may think to yourself, well, you know, that doesn't make sense. The company is issuing more shares into the market without raising any capital, and the current investors are seeing their overall position dilute. Okay, the value of their position is not the same as it once was. But there would be a good reason behind that. It could be a way of issuing shares to clients rather than dividends. So what I mean by that is, if a company is not in a position to issue a dividend, a cash dividend, they may decide to say, look, we're going to do a bonus issue, and by that, all our shareholders will benefit from additional shares. Yes, the overall share price may come down in the initial term, but in the long run, if the share price does rebound and it captures that new audience that they ideally look for, then it could pay off quite handsomely. It could be a signal of confidence. You know, a lot of companies that do a bonus issue will feel that, we're great at this moment in time. Our fundamentals remain strong. We don't mind diluting the overall share price in the near term. Okay, as fundamentally we're still very strong. So even though we have taken a slight pullback on the share price, it's not an issue. Okay, it's unlikely for a company that's struggling to do a bonus issue. Okay, but again, it's just a way of capturing a wider audience. Improving liquidity by increasing the number of shares in circulation, it will enhance the stock's liquidity. So their order book will look that bit more liquid, and if investors look at an order book and they see it's fairly liquid, they think, this it's not going to be susceptible to, big gapping or anything of that sort of nature. We've already discussed, accumulating or attracting investors, as that is one of the key reasons you're more likely to buy a share price which is 50p rather than a pound, for example. Then it could have some form of behavioral finance involved, but you rather buy a stock when it's a lot lower in value. What I've done here is just a very quick slide to put everything we've just discussed into a simple graph. It will help you, just distinguish the two, especially if you are taking your exams at some point. A lot of what we're going to discuss, or everything we discuss in this course, is going to be relevant towards your exam. So, yep, use this, understand, are shares being increased, is new money being raised, what effect it will have on the overall share price, and the reasonings for doing it. That's the key part. When you do see articles and you are trying to explain to your client or your prospective client why they've gone about a rights issue or a bonus issue, you need to understand the reasons, and they'll be able to comprehend it that bit better, and then make an educated decision on whether that company is a good company to buy or not. Okay. Yeah, so it's just purely a summary. Okay, we're going to get into preference shares right now. Many may have come across them in their time, but when I talk about preference shares, they also go by the name of preferred shares. They are a type of security that offers very similar characteristics to common shares as well as fixed income security. The key benefit is holders of preference shares are typically given priority when it comes to dividend payments that the company may issue. So if you are looking to purchase preference shares, it will come with a par price or a par value. It will be a different price to what the current share is currently trading at. But naturally, when you do buy something, there will be price fluctuations like other securities. So preference shares will be subject to market conditions that can fluctuate based on whether it's supply and demand dynamics, interest rates, or as well as financial performance. So be fully aware when you are buying preference shares, you're not buying it at the live market price as you would a regular ordinary share, for example. Now, one of the key characteristics to preference shares is going to be the dividend element, the fixed dividend element to be more precise. Preference shares will come with a set dividend. It will be a specified amount, percentage per year or semi-annually, and that's one of the key characteristics for investors. If you are investing in preference shares, as an investor, you are thinking, okay, fine, I'm going to be getting a predictable, reliable income on a yearly basis. You won't benefit from the overall growth of an organization, well, not to the extent an ordinary shareholder will, but you are guaranteed to a certain degree, and we will come on to the guarantee part in a bit, but you are guaranteed to a certain amount to receive a predictable income by way of dividend every year. Now, when it comes to the liquidation element, preference shareholders will rank higher. They will have a higher claim on a company's assets before any other shareholder will. In the event of any form of liquidation, you've got to be prepared that ordinary shareholders, they do stand to gain the most, but they do also stand to lose the most. So they will always be at the bottom of the table. But when it comes to preference shareholders, if there is any assets left over, they will tend to be paid first. And one final element on preference shares is the voting rights aspect. Preference shareholders usually come with limited to no voting rights. So they won't really have a say in any form of corporate governance matters, whether it's electing a board of directors or voting on any major corporate policies. So, yeah, in a nutshell, that is preference shares. Preference shares, to summarize, allow investors to have a set fixed dividend yearly. They won't naturally see overall growth if the company does continue to grow, but if the company does also fall in value, they at least have a set dividend that they can expect on a yearly basis. So that's the key characteristics for preference shares. Okay, what I've done here is I've put together a summary of the ordinary shares and preference shares, just so that we can fully nail down what we've learned about the two, just so that we're in a clear mind moving forward. So when we talk about ordinary shares, that represents naturally an ownership in a company. It does come with specific features as well as benefits and cons, so we will go into that. First and foremost, let's look at the dividend aspect. Yes, as an ordinary shareholder, you typically have a voting right, so you can vote on any form of corporate matters that we have discussed, whether it's the board or corporate policies in general. Dividends will be variable. You are entitled to dividends if the company is to issue it. It could be a good year one year, it could be a bad year another. So dividends will be variable, whichever way you tend to look at it. The main element of being an ordinary shareholder is the growth, the capital appreciation. Ordinary shareholders can benefit from an increase in the share price, which does offer capital gains, and that's what we always look for when we invest. And when it comes to any form of claim, as I mentioned in the previous slide, ordinary shareholders are ranked at the bottom when it comes to liquidation. If a company does go under, if there is any money left, it will be distributed at the very end. A number of the features that are attached with ordinary shares, one is a redeemable or a callable feature. This is in essence when shares are bought back by the issuing company after a specified time and after a specified date, as well as at a predetermined price. So companies can issue shares with the option of recalling those shares at a later date with a set price. So if you are to buy redeemable shares, you will hold it for an X period of time, and it will be bought back at an X period of time. There are pros and cons attached to it. For example, if the stock price is £2 today, and the company says we will buy it back off you for £2.50, for a fact you're going to get that small amount of appreciation. But when it comes to the redeemable time, the share price could be £3, and the company will only buy it off you for £2.50. So there is that element of it. But it could work out in your favor if the share price goes down to £1.90. The company is obliged to buy it off you for £2.50. So there are those elements. So be fully aware of any pros and cons attached if you are looking at redeemable shares. That can be redeemable preference or ordinary shares. There are certain classes of shares. I've mentioned two here. You've got A shares and you've got B shares. A shares, a lot of it will just focus around voting rights. So with A shares, they typically have more voting rights compared to B shares. So they can carry multiple votes per share. So if you own one share, one A share, that could be the equivalent of 10 votes, for example. So it gives the holders greater control over corporate decisions. So that's one way of looking at it. Then you've got B shares. They often have very fewer voting rights compared to A shares. So it could be very often if you own one B share, you're only entitled to one share. But the crossover and the the way to make B shares look attractive is they will offer higher dividends to compensate for the reduced voting power. So that could be one way of really benefiting from B shares. And then you will get partly paid shares. This is investors will only pay a part of the share's total price up front, with the remaining balance due, in a number of installments or at later dates. So holders will have partial ownership. They may receive partial dividends and voting rights. It tends to be also a marketing ploy where if a share price is too expensive, um, companies may offer partly paid shares where you can pay off the shares in installments. So, that's one way of looking at it. And then finally, you will get deferred shares. This is when dividends on deferred shares are paid after dividends on ordinary and preference shareholders. So, in the event of liquidation, deferred shareholders, have a claim on assets, but only after shareholders and creditors have been paid. They do carry a higher risk if you are a deferred shareholder, um, but there are potentially higher rewards if the company performs exceptionally well. So that is ordinary shares in a nutshell. Okay, we're going to go into preference shares now. Um, as mentioned, when it comes to liquidation, we know that they will rank higher than regular ordinary shareholders. Um, so that's one way. Many could see that as a benefit, but that's just how liquidation will work. When it comes to the dividends, dividends are fixed. Okay, they will provide regular income to investors. So that's one of the way of it being such an attractive way of investing. When it comes to voting rights, as mentioned on the previous slide, there is limited to no voting rights. So when there are big corporate decisions or appointments of board members, preference shareholders won't get involved. But you got to remember why they invest to begin with. If you're investing in preference or preferred shares, you're there just to pick up that fixed dividend, and that's about it. You're not so much focused on the overall growth. Now we're going to look into some of the key features because there are multiple different types of preference shares out there that you can buy. The first one we'll look is cumulative preference shares. What that tends to mean is if a company skips a dividend payment, so say for example, as a preferred shareholder, you were due a dividend in year one, but that didn't happen, it will naturally accumulate. And in year two, for example, if they still haven't paid it, in year three, if they have the funds, they will have to pay any unpaid dividends to cumulative preference shareholders before anybody else. Okay, it's just a feature that provides additional protection for investors, ensuring that they will eventually receive all due dividends. The next one we'll look at is participating preference shares. Now, this tends to be a very common one as it allows shareholders to receive additional dividends in the company if it performs well. So not only will you're guaranteed a fixed income, if a company does reach a certain threshold or a share price or a revenue level, then participating holders will get an elevated amount of dividends. So in essence, you're benefiting from a company's performance, which is ideal, and it tends to be a very common one. And the next one we'll look at is the convertible preference shares. It allows shareholders to convert their preference shares into a specified number of ordinary shares at a certain point in time after certain conditions are met. It allows investors to benefit from potential capital appreciation within the common stock. So as a convertible holder, your aim is to believe, okay, I will have a set amount of fixed dividend, but if it reaches a certain point and the company has met all its targets, I can convert my preference shares into ordinary shares and then benefit from the maximum growth. Now, the final one will be a redeemable preference share. Again, it's very similar to an ordinary share. Preference shares will be issued for a certain duration of time, and during that duration of time, you will be entitled to a fixed dividend. So you know what you're getting year in, year out. But once the time does come where the company wants to take back or call upon those shares again, they have the duty and the entitlement too. So yeah, in a nutshell, those are ordinary shares and preference shares. Be fully aware, investors will more than likely be having a large portfolio focused on ordinary shares, but may also have exposure to preference shares, especially if you've got an investor which is predominantly seeking income. Of course, you're more than right to target, good dividend paying sectors, but be fully aware there is also preference shares in order to lock a fixed dividend in for your clients. So bear both in mind and the pros and the cons attached to both.